If you're retiring and you have company stock in your 401k, then you need to look at the tax benefits of net unrealized appreciation before you make any decisions. Net unrealized appreciation is the deferred gain on that company stock that is in the 401k. So maybe you work for Lockheed Martin or Texas Instruments or one of the other big companies that allows you to buy company stock within your 401k. And you've been doing that over the years, and you have accumulated a large number of shares of company stock, and that has grown at a very nice rate over all the years you've worked for the company. And so now you have this gain in the company stock. And let's say that you had $25,000 invested, and it had grown to be $250,000, just for sake of an example. Well, the $25,000 is your cost basis, $250,000 is the current value, so the gain is $225,000. That is the net unrealized appreciation. At the point of retirement, you have the opportunity to take the company stock out of the 401k and move it into a taxable brokerage account and pay tax at that time only on your cost basis. That would be the $25,000 in this example. And you get to defer the tax on the gain until some later point in time. But you will pay the tax on the gain as capital gains tax, not as ordinary income tax as it would be taxed in an IRA. That can be a tax savings of 10 or more percent on that difference, on that net unrealized appreciation. Now, this can be beneficial to you because not only are you saving tax on that portion of the gain, you also are removing that $250,000 out of the tax deferred world and into the taxable world, where it no longer counts as part of your funds that have to be used to provide a required minimum distribution. It no longer is a part of that calculation, so your future required minimum distribution will be lower, and that can be beneficial. That net unrealized appreciation, that is also a benefit that you can pass on. Your heirs would be able to cash out of that stock and pay long-term capital gains on the net unrealized appreciation. Now, they don't get a step up in basis because it came out of a 401k and was rolled into the taxable world, so there is no step up in cost basis to your heirs, but they do get to pay capital gains rates on that, as opposed to having to pay ordinary income tax on what they inherit under the IRA. On top of that, they're not subject to any timing on when they have to distribute that. They don't have a 10-year time period that they have to cash out of that stock, so they can time it, keep it, whatever it is that they want to do. They have a lot more flexibility and control. So by doing the net unrealized appreciation, you get to reduce your income tax. You have some more flexibility and control, and the same is true with your heirs. They would have lower income tax and they would have more flexibility and control. You have to consider the fact, though, that you will need to hang on to that company stock in order to continue to defer that capital gain tax until the point in time that you want to sell it. And so you would want to look at, well, what percentage is that of your overall portfolio, and does that make sense? What is the risk to you, and how much does it minimize the diversification that you're able to do? And have a plan for that. It can still make sense if you have a workout plan where you're diversifying over a number of years, but you're getting to do that at a lower tax rate. And you may be able to use some of those gap years and pay almost no tax on the capital gain if you're in some low income tax rate years where you qualify for the 0% capital gains bracket. Those are things to look at, things to analyze, and things to consider so you don't miss an opportunity to improve your retirement situation. Now, I hope that was very helpful. If you like this video, please subscribe because there's going to be more like this to help you be on your best path for your retirement.